the 7 deadly sins of investors and how to avoid them. And of course, this is not financial advice. Did you know that 90% of investors underperform the market? Doctors and lawyers, they go to school first and then after they will go up and hang a sign on their door saying that they are a doctor. But investors are the opposite. They normally first hang up a sign on their door saying that they are investors and then they go to school. And we can see it here. Isaac Newton went broke. If you don't know Isaac Newton, he's one of the smartest people that ever lived. He literally invested a lot of what we know as physics. So here is his investment in South Sea stock. So here we see Newton invests a little bit of his money, then he gets out really happy at a profit of about 100%. But then Newton's friends get rich from the stock because they didn't sell. Then he enters with all of his money again, gets a little bit excited, and the stock crashes and Newton ended up broke and lost all of his money. Another thing that investors don't know is that the best investors normally take 5 to 7 years before making consistent returns. So here we see Mark Minervini's career highlights. Mark Minervini is one of the best stock traders and investors alive today, and he has been averaging about 100 to 200% for a very long time. But here we see how he started out in his career. First started out trading, and during the first 5 to 6 years, he actually did not make any money. And then we can see that as his career goes on, he keeps making more money because he has more experience. He has learned how to get over his mistakes. He's not committing the 7 sins that I'm about to show you. So we can see that over in 1994 to about 2000, he averaged around 220%. In 2021, he won the investing championship with 334% return. So here we can see that a lot of investors get stuck in this 5 to 6 year period and they give up. But saying that, let's go to the sins. So sin number 1 is investors not changing their minds. Just as Livermore said, the speculator's chief enemies are always boring from within. Just as Livermore learned this lesson the hard way in 1907. He had correctly predicted a bear market and he was making a lot of money while shorting stocks. But then he failed to adapt when conditions changed. As he says in his book, I was so sure of my bearish position that I didn't look for danger signals. And this stubbornness cost him his entire fortune. Livermore later said, not even a world war can keep the stock market from being a bull market when conditions are bullish. So the lesson is you should always be willing and ready to change your mind as an investor. I can show you a really good example, which is CrowdStock. Now, CrowdStrike was a very interesting stock that crashed earlier this year. I bought the stock around here. I bought CrowdStrike around when it gapped up after earnings. So I bought CrowdStrike here. I was waiting for it, of course, to go to $500, $600 because it looked like a sure play. And during that time, it did look like a sure play. But I remember when the stock started failing here, I didn't know why it was failing. I knew something was wrong. And on this particular day here, CrowdStrike then gets a major technical issue that crashes the stock. Now, a lot of people might be saying that, the technical issue crashed the price of the stock. But the fact is that the stock had already been collapsing before the hackers hacked into CrowdStrike. So the hackers were just a catalyst, but there was already something wrong. And until our next sin, number 2, believing in stories and not prices. Joseph Livermore is one of the best traders ever. And he said, the tape tells all. And the tape, back then, they didn't have charts, so they used to see the price of a stock on a ticker tape. He has a story in his book where he ignored this principle and he lost a lot of money. He says that I was very bearish on United Steel. I had put in a very large short line. But then I got a tip from a reliable source that a big buying movement was about to begin. So just a little more, was told that somebody with a lot of money was about to buy this stock. So despite his own analysis, Livermore covered all of his shorts because the technical analysis was showing Livermore that, hey, please short the stock. But he had a story from his friends that was telling him, buy the stock. So despite his own analysis, Livermore covered his shorts and even went long. The stock eventually tanked and then he lost a lot of money. Always remember, the price action tells a true story. If you get a tip from the news or your friends about a certain stock, do not buy it immediately as an investor. You have to first wait for the price to prove that tip. Because normally what people do is that they'll send out false tips. So they'll say that, hey, NVIDIA is going up so that people can buy up the stock and then they'll give you their shares so that they can exit the stocks. That's normally what hedge funds do. When they have a very big line of stock to throw away, they will try to make up a good story about the company. And then when people get excited and buy, they can just dump the stock onto those people that are excited. Sin number 3, not picking the best stocks. It isn't as important to buy as cheap as possible as it is to buy at the right time. A good story that he has in his book is just a little more. Remember an experience of his that taught him the importance of understanding the broader market. He learned that he should invest with the broader market and not fix it on individual stocks. So in 1906, he noticed that all stocks in the market were behaving similarly, regardless of their individual merits. As he remembers, I wasn't concerned with individual stocks, but with the whole market. My plan of trading was based on study of all conditions affecting all stocks rather than on the power and prospects of a single corporation. He saw that Pacific Union, a stock he was really familiar with, was behaving very weirdly. And instead of focusing on this particular one stock, he looked at the entire railroad sector and the broader market. This comprehensive view led him to take a short position across multiple stocks. And when his analysis proved correct, when the San Francisco earthquake hit in 1906, it caused a market panic. Jesse Livermore made $250,000, and this is equivalent to millions today. The lesson is very clear. Focus on the broader market trends and position yourself accordingly. A very good example is semiconductor stocks this year. So let's see what happened. If we go into TC 2000, but if you want to be in the best stock in the stock market, you must always be in the best industry in the market. So let's see, semiconductors. Now I know NVIDIA did very well this year, but let's see what happened in a lot of semiconductor stocks. So here in this chart, I'm showing you what it really means to focus on a good sector and choose the best stock. So the best stock in the stock market normally is in a winning sector. So earlier this year, a lot of people were looking at NVIDIA as a winner, but the fact is that semiconductors were moving as a whole. NVIDIA was just the best among semiconductors. So let's look at semiconductor stocks and what they've done this year. Let's look at the bigger ones. NVIDIA did about 180% this year. So that was a very huge profit, but it is not the only stock that did that. Taiwan Semiconductor Manufacturing Company, we see it did 90%, right? So it is not necessarily the stock itself. It's normally the industry that the stock is in. So when we go back, what is the best stock? It is the best stock in the industry, the stock that is ready to be bought. So you must be buying at the right time. And you should always focus on industry moves because stocks move in industries, as I showed you earlier. And if you want to be getting the best returns, you must focus on the best stock in the industry because that stock normally vastly outperforms the other. So 80% of profitable moves in the stock market history come from bullish industry. Sin number 4, not cutting losses short. Learn to take losses quickly and cleanly. Let me show you a very good example of this. We have two fund managers. Manager 1 returns 30%, 20%, 25%, negative 5%, and then 20%. Now this looks like very mere returns compared to manager 2 who has way bigger returns, 70%. Then it goes next year he only does negative 20%, but then next year it does 80%, then negative 35%, then 40%. So manager 2 has bigger profits as we can see. But then if we are to check the overall compounded return, you can see that manager 1 will have 120%, but manager 2 is going to have a 100% return. When you lose money in the stock market, it affects your ability to make money next time. So here we can see Mark Minervini's loss adjustment chart. He realized that if he had cut all of his losses short at a certain percentage, then he was going to make a much bigger return than if he let his losses run. So here we can see his gains and his losses from his accounts. So he had very big losses that he took because he wasn't cutting his losses short. And you can see what happened to his account. But then he realized that, hey, what if I cut all of my losses at 10%? So you see I adjusted for all of the losses for 10%. So his return went from negative 12 to a 78%. So you can see how losses really affected his portfolio. Sin number 5, chasing the next Tesla or NVIDIA. There's nothing new in Wall Street. You don't need bangers to make money in the stock market. I already showed you about the investor that had very huge returns but did not cut his losses. You just need a good system that will always put you in such stocks. So instead of looking for the next Tesla or NVIDIA, find a system that will always be putting you into the next Tesla or NVIDIA. And just a little more also knew this. Livermore warned against the temptation to chase hot tips or the next big thing. Remember the time when a friend gave him a tip on a stock called Consolidated Stuffs. Livermore, against his better judgment, bought heavily. The stock actually tanked and then he lost a fortune. Then he remembered and reflected. The nature of the game as it is played is such that the public should realize that the truth cannot be told by the few who know the truth. So instead of chasing rumors, Livermore advocated for patience and thorough analysis of market conditions. Sin number 6, giving up and not trying again. The game taught me the game, and it did not spare the rod while teaching. Just so Livermore. There are 2 types of giving up that I recognized. There is giving up on trades, and then there is giving up on your trading career. You have to remember that it took 5 years for Jesse Livermore to learn how to play the game intelligently enough to make big money when he was right. The best investors actually never really make the good money in the first 5 to 6 years. And during a lot of this time is when a lot of people give up. The problem with investing and trading is that it is very personality based. There are millions of ways that you can make money in the stock market, and you cannot apply all of these ways because you just have limited money and time. So you have to pick a few that match your personality, but the journey of finding that thing that matches your personality is a very long journey, and also getting over your emotional states takes a very long time. So you have to be patient, and that's why you started with very little money, right? So that as the more you gain confidence, then the bigger profits you make. Then another type of giving up is on trades. Investors, once they lose money in a trade, they give up on it. But the fact is that the best investors will always re-enter a stock that has stopped them out. And let me show HIM's stock, for example. This was a very interesting stock. So I did buy the stock here on earnings gap, but then it failed. So I was stopped out and I lost around $30. And then I bought it again and then I made 90%. A lot of people give up, but in the stock market, it's not about giving up. Sometimes the stock will shake you out a little bit, but then you have to come back and keep trying again. Tesla, which is also a very good example. I released a video and I told people, hey, buy the stock here. So I sent out an alert on my YouTube channel. And initially when I bought it, it stopped me out. So I lost around $30 to $40, but I bought it back again and made around $500 on the stock. So what I'm trying to show you is do not give up. SMCI was the same. Yeah, I did buy it initially here in the first breakout and I got stopped out and I lost $50. I bought it again here and then it did a 240% return. Don't give up on stocks or trading career. Sin number 7, not liking and subscribing to this channel. If you like this content, please like the video so that the algorithm can spread it to more people, and also subscribe to the channel for more videos than this. For a motivational story about persistence, think about this Livermore. This guy went broke several times in his career, but always came back. And after one particularly devastating loss, he said, I had learned my lesson. I was flat broke, but I knew why and I knew how. I was not altogether rotten yet, and instead of giving up, he analyzed his mistakes, refined his methods, and came back stronger than ever. That's why he famously said, the game taught me the game, and it did not spare the rod while it was teaching me. May the markets be with you. Thank you.